Welcome viewers to this virtual panel discussion focusing on gold mining investment and the opportunities arising in the London market. This video session forms part of the one-to-one mining investment EMEA online event for autumn 2020. I'm delighted to host an auspicious group of guests on this panel with a breadth of expertise across the gold mining sector. I have with me today James Wallbank, Managing Partner of Ibaera Capital, Peter Marrone, Founder and Executive Chairman of Yamana Gold, Randy Smallwood, CEO of Wheaton Precious Metals, Eric Zurin, CEO of Shanta Gold, and Sam Catalano, who is the lead mining equity analyst at Canaccord Genuity here in the UK. A warm welcome, gentlemen. James, I want to start off with you and get your view as an investor. Are we seeing a change in sentiment from the AIM and LSE investors towards mining companies at the moment?
Well, good morning, Adam. I'd certainly hope so. I mean, gold has certainly been the big story of 2020 so far. And, it's fair to say compared to the TSX and the ASX, AIM has not responded to the same extent as those markets. It's by far the market that is lagging behind. And I think most investors, and certainly ourselves, are keen to be adding more gold to our portfolios. And, as a result, we're looking for markets like AIM where there is perhaps still more value to be had than perhaps what exists on the TSX and the ASX today.
Yeah, certainly. And you think the prevailing economic conditions are sort of driving this spike for the TSX and ASX stocks? AIM's sort of lagging a little bit behind for any particular reasons, or it's got some catching up to do?
Well, I mean, they're clearly different marketplaces. I mean, the TSX and ASX are particularly mature gold markets. AIM has been soft in this space for quite a while now. I think, probably AIM carries less than 10% of the number of gold stocks that the others do. But particularly, I think this year we've seen TSX and ASX gold companies under $1 billion more than double, I think, up from their lows more than 2.5 times. I think AIM comparatively is up less than 50%. So there's plenty of opportunity, I think, for increased value in the AIM marketplace. I think there is some issues around the quality of the assets that sit on the AIM market. They're simply not as mature and as robust. But I think the European, the international investor is looking for quality assets that are with quality management teams. And there's no reason that those things can't exist on the AIM marketplace. They're just not there to the same degree as the other markets at the moment.
Yep, certainly. Okay. Sam, could I bring you in here and get the analyst perspective? You cover a lot of companies. You talk to a lot of investors. How do you see the investor mindset changing here in London at the moment towards gold equities?
Yeah, look, I'd have to agree with James' comments there. Look, having started my career in the Australian mining industry and then in the Australian equity industry, but having now been in the UK for about 15 years, I think one of the key differences is just the amount of ex-technical people, such as myself, in the markets like Australia and Canada. And you do have a little bit more, I guess, money behind generalists in the UK, generalist investors. And probably given they're coming from a slightly different perspective, they typically need stronger stories, lower risk stories, clear stories. And that probably feeds into how the different markets have traded of late. But if we just step back this year, even on the AIM and the LSE, we saw the start of the year, the larger cap names run very hard, as COVID started to hit. As we went into the second quarter, we saw some of the growth guys do quite well. And then now as well, you've got investors focusing on some of the exploration players in London. So look, there are investors that are interested in all stages of the project development life cycle and company life cycle for that matter. it's very difficult to find any investors, generalist or specialist, who really disagree with the top-down narrative on gold prices, given the actions of central banks around the world. But I think the key thing that I'd point out, and James alluded to this, was what you really need is a strong, clear story, as a company, for investors to get interested. And I've got a number of investors who sort of, I guess, jokingly say to me, "Look, Sam, if I have another company come in here and tell me that they want to be the next mid-tier producer in X jurisdiction, I'm going to throw the presentation at them." And look, there's nothing wrong with that in and of its own, but you need to have a clear pathway for how you're going to achieve that as a company. And if that is there, then that's something that investors can latch onto, and certainly that will hook the interest.
Okay, that's excellent. We'll come on to some of those sort of points of what might hook the interest, or some of those attributes that differentiate the company stories from the good ones from the bad ones in a bit. Thanks, Sam. Let's hear from the company leaders now, though. I want to get a sense of what quality mining companies, why they might be coming back to London. Peter, could I take this opportunity to bring you in here and to talk about your Yamana's position on the LSE and your recent listing, in addition to Toronto and New York? What was the attractiveness there?
Sure, and first of all, thank you for inviting me to this panel. So is there a sentiment change relating to listing on the London Stock Exchange? I find this fascinating. London is a very robust market for mining generally, and yet it is not a place where gold mining companies in particular would look at as a stock exchange. Clearly, Toronto is there, other stock exchanges in the world, the New York Stock Exchange, but London does not appear to be, at least, the first pick for gold mining companies. And while it is anecdotal, we have two panelists on this call today that have made the choice to say that we think that there is a fertile market here, that we have a story to tell that is a good story, and it is consistent with what investors are looking for. It appears to us, my personal view is that it's undeniable the gold price is something that is on people's minds. It's at the forefront. It's undeniable the gold price has done remarkably well this year, and I think that's attracting people to what does one do to invest in it. And part of the thesis that we're presenting is that it's not just about the gold price, it's about the gold equities and the various factors that allow gold equities to overperform gold. And it seems as if that message is resonating with London investors, why we found it attractive. And I guess if I can take a step back, I would say that it is the obligation of executives of mining companies, the leaders of mining companies, or any company, to find investors, go where the money is. And it seems to us that there is fertile ground for considerable numbers of dollars that are in investment funds that are located in London or prefer a London listing, either by design or by desire. They're looking for a London listing. But it is a considerable amount of capital, and some of which, at least it appears to us, wants to be deployed into the precious metals mining space. And so we're saying if that money is there, and it appears that it is, and investors are now interested in gold as a metal, they should be interested in gold equities. We're making the case as to why gold equities should be the better investment. And in time, my belief is that will reflect itself in our shareholder register. At the end of the day, that's our obligation, as I mentioned, which is to find new investors, find new sources of capital, which ultimately should lead to improvements to overall share price performance and returns.
Absolutely, yeah. And you feel there's been a lack of quality companies that the London-based investors have had the opportunity to invest in over recent years. You think of things like Rand Gold coming off the market. There's left a gap for you here that you're going to exploit.
Well, it's difficult for me to say quality companies, but I would certainly say that there is a shortage of companies. And that would imply, I guess, that there should be more quality companies on the London Stock Exchange. That isn't to say that we should be denigrating the companies that are there. That's not my point. But I certainly think that there should be more companies that are listed on the London Stock Exchange. It's a large market. There are significant pools of capital that are available. And given the interest in gold, I think that we can make a compelling case that there should be an even greater interest in gold equities because of the margins that expand with higher gold prices, the robust cash flows, all of the good reasons that are there for why one should be invested in a precious metals mining company during a rising precious metals price environment. And so, yes, I think that there should be more companies listed, certainly given the seniority and the tenure of the London Stock Exchange and the pools of capital that are available. We hope to exploit that. That's a strong word, but we do hope to exploit that. We think that we make a compelling case for investment. I'd like to make one more observation, Adam, and
Please,
that is that in order to keep it simple, what I'd like to do is I'd like to eliminate the words precious metal or gold from this discussion in some respects. I'd like to be able to say, independently of what it is that we do, although clearly at the background one needs to be sensitive to what we do, if the thesis is that there is some strength and resilience to the prices of the materials that we create, the product that we create, then one should be looking at the financial performance of the company to determine, is it a viable investment and how does it compare to other companies, perhaps even in other sectors? And so we're looking at it and saying, if the broader market is trading at multiples to cash flow, enterprise value to EBITDA, that are at about double what the multiples are for the precious metals mining companies, then disregard for a moment what it is that we produce, the product that we produce, look at those cash flows, look at those margins, and come to a conclusion, does it make sense that there should be that disparity? And markets abhor disparities, and my view is that over time, then we will attract those better multiples and those better share prices. And London investors will take advantage of that if they're investing in precious metals mining companies.
Absolutely, excellent point there. Yep. Randy, could I bring you in and ask for some additional comments to that? And also, obviously you have a slightly different model being in the streaming royalty space, but what was your sentiment towards the London market listing and some of the points that Peter's echoed there around the fundamentals of company performance attracting the liquidity here?
Well, that was a pretty good answer on Peter's part. I love this comment at the end because I've got some friends in the tech space that talk forever about revenue, but never ever want to talk about profit. And that's the only thing that drives us in the mining industry. And so it is funny, is a next home. We've already got substantive shareholdings in London and in Europe, and to be honest, they're over there probably in normal times, over in London probably 8 to 10 times a year for myself, and even more for the rest of the team. And so it was just a natural next step for us. And to echo Peter's comments, it's our job to sort of expand our shareholder base, and that can only bring positives to our existing shareholders. And the more people we have interested, the more people that we know that understand, our companies, our respective companies, the better off our existing shareholders are. It's a pretty simple equation. And then you look at the London Exchange, and again I echo, there are some pretty good quality companies, gold mining companies on the London Stock Exchange. They're not very diverse from a geological or from a geographical perspective. Sorry, and I think that's what Yamana brings, and I know that's what Wheaton brings, is diversity in terms of exposure to a number of different jurisdictions, a number of different assets, as opposed to specified single jurisdictions like Russia and possibly Ghana and things like that. And so that diversity is one of the additional. So that's one of the voids that we saw, was that there's not a lot in the precious metal space, not a lot of diversity being offered by what's on the London Stock Exchange. And yet here we are. I mean, I've seen a lot of comparisons here in this conversation between the ASX and the TSX and the LSE, and I actually think the LSE itself should be more compared to the New York Stock Exchange. I would rank it as probably the second or third most important exchange in the world. And it's more the AIM that I would be comparing to the TSX, or maybe the TSX Venture Exchange, and of course the ASX. And so there's no doubt that London's an important financial center, and it always has been, for a very, very long time, and it will be in the future. Even through Brexit, it will survive. And so, for us to come in there, we do have a bit of a unique model from the streaming perspective, and so it is a different model that has never been offered at any type of scale on the London Stock Exchange. And our reception has been phenomenal, actually, in terms of the amount of interest that we've had in this new business model, which it's not really new. It's been around. We created it 16 years ago here in North America, and it's been very well received. But we've been very happy with the response to date. This is all about expanding our reach, and I have not found any reason why a company wouldn't do that. So some people talk about having to satisfy governance issues with respect to multiple exchanges. I mean, all that does is make us a stronger company, and so that's not a valid excuse in my eyes. And ultimately, we have to come up with governance that satisfies whatever regulatory environment there is around us. And so that to me is a net positive, and it's a matter of just having to go through a few more hoops and processes and making sure that we have systems in place. Ultimately, it makes us a stronger company. So I haven't heard a valid excuse as to why people wouldn't, and I would expect that there will be more coming. But Peter was ahead of the bunch, and we came in shortly after him.
Can I ask, just on the timing of it, Randy? Has it always been a sort of long-term consideration or strategy to have the listing in London, or is it something that's sort of arisen more recently as the markets have evolved and changed?
We first started talking about it over 2 years ago, and started putting, investigating into just to see what kind of funds were available. And there is a large amount of funds in the UK that have restrictions with respect to investing outside of the UK. And so by having an LSE listing, it does open up the opportunity for them to invest into Wheaton Precious Metals where they might have other challenges to do that. And it doesn't mean that they're going to use the LSE. We're not expecting. We didn't come in and raise money. In fact, our company is so strong that I don't see us having to raise money, possibly never again. And so it's tough to come in and have a listing on the LSE, but not have any type of a financing that puts some liquidity into action. But for us, the true measure is just those funds. They can buy our stock on the LSE, but they can also buy our stock on the New York Stock Exchange or the Toronto Stock Exchange. Now that we're registered, they don't have to use the LSE as the actual marketplace to exchange the stocks, and so it has opened up. We already know of several funds that have been actively buying into us that are a result of this, and so it's been good.
Yep, thanks. Excellent. Eric, could I bring you in here? I think we've had sort of a great opener, but a slightly biased view towards the multi-billion-dollar value companies. I want to get your view here as leader of a quality junior mining gold company, and get a sense of what's your take on the opportunity within AIM and the London investor base. You recently had a capital raise as well. I understand that was mainly London focused. Can you talk us through your views?
Yeah, no, it's a good question. A lot of good input. But listen, I mean, Shanta's been listed on AIM for 15 years, so we've been around a long time. Now, what I think is different, and this you can refer to this capital raise. We just went out. We had about 50 meetings in a matter of 4 days, right across North America and the UK. And what's obvious to us, because we've seen this time and time again, is that London investors are typically more generalist. You don't get as much value for exploration opportunities. They understand businesses.
Yep.
What does the cash flow indicate? And I think it's interesting because the equity story in London, needs to be catered to around a cash flow producing asset that can ultimately pay a dividend, because I think that's quite different than what you'd find in North America. And I mean, London's a fantastic place to be listed. There's massive pools of capital. It opens the door to Europe. So it's, you know, AIM or the LSE, terrific, but the equity story is different. And you just need to be conscious of that with the investor pool.
Yeah, certainly. And how are you finding it as a sort of single asset company as well? Does that help you get your story a lot clearer and a lot straighter out to this investor base? That was mentioned before, that multi-asset companies have an advantage, but actually might not always be the case. I'm just playing devil's advocate here.
Yeah, we've just acquired this high-grade project in Kenya. So now we have 3 assets in 2 countries. That helps the equity story, diversifies the risk. Investors can see that there's clearly growth potential, but they always come back to the underlying cash flows. You know, fundamentally, what are they buying? And if the growth works out, fantastic, because you have a kind of a value and a growth story. So, you know, for us, I think getting away from the single asset, single jurisdiction equity story is important. It's, you know, and you know, I don't need to tell the reasons why, everyone knows it. And it helps with the overall marketing in London. I mean, investors, as I said, they're generalists. They look at the risks, and they'll want to see some kind of diversification across your portfolio.
Yep. Okay, absolutely. So that's a great introduction of where we sort of stand within the London LSE and AIM markets and their appeal at the moment. I'd like to put to the panel then, look, obviously things are good now with the wind in the sails for gold mining. And at Peter's request, we won't be going down the route of talking about the price too much. But what I wanted to move on to was some of these fundamental characteristics or deliverables that the companies are performing on. What can we hone into some of those as to what would make them very attractive right now? Eric, you cite cash flow as being number one for the London-based investor. Sam, is there anything that you see that the investors are looking at in particular in this market? Is it dividends that investors are going to be wanting to ask of companies at the moment, for instance?
Yeah, so let me touch on a couple of things as well that were just said, and then I'll answer your question directly. You know, I agree with the comment that there is a lot of generalist money, a lot of generalist investors in London. You know, if we actually look at performance this year, so year to date, you know, let's start at the top end. In the FTSE 100, 2 of the top 5 performers this year are precious metals companies. And that's amongst FTSE 100 that, as we've covered, doesn't have a great deal of precious metals companies in it. So there is appetite for this space amongst those generalists for good stories. Secondly, and I think most importantly, when we're talking about companies listing in London, is the fact that there's around $1 trillion of equity investment assets under management in London. Now, around 40 to 50% of that is UK/European focused only. So it's that pool of capital, which is largely generalist money, that I think, you know, when Peter mentions, you know, tapping into those pools, that's the pool, you know, that was unavailable to companies listed elsewhere before. So there is definite opportunity. And, you know, as the comments were made, I think that, you know, a good company is really a very good place to start in terms of fundamentals. To answer your question more specifically, you know, I think given that background of, you know, a lot more generalist investors, and look, that's not to say at all that there isn't opportunity for, you know, exploration or smaller players at all, because there's plenty of people that are interested in that. But, you know, from a generalist perspective, if the story is, I guess, as not as low a risk, but as with little complications as possible, that's a huge advantage. So, you know, we all know that, you know, some startup miners, for example, can have some fairly creative ways to fund themselves in the very early days. Yeah, and to the extent that those things can be tidied up pre-listing in London, you know, that's always advantageous. So it's not just the operations, it's thinking about balance sheets as well. Is very important. Cash flow has been mentioned a little bit here already. Definitely, look, cash flow for operators provides them with options, and that's a great thing to have. But I think, you know, with the years, this isn't just a gold mining comment, this is certainly across the sector as a whole, with the sort of 2013 to 2015 period still fresh in the minds of many investors, when the big names listed here, BHP, Rio, Glencore, Anglo, clearly went through a period where they had overinvested significantly. Balance sheets were stretched. They've managed to really turn that around the last few years. But the capital allocation of that cash flow is absolutely vital. So, I think investors need confidence in the management teams in how they're thinking about allocating that capital. And certainly if you're a generalist, you might take the view that the mining sector always tends to blow up capital when it gets it. And hopefully, I think the companies that will do well here are those that really provide a good explanation or good framework for how they want to allocate their capital towards, I guess, higher returning projects. Last thing I'd say in terms of characteristics is, I'd urge management teams not to gloss over their ESG or sustainable management credentials. Absolutely vital. Now, you'd be hard pushed to find a fund that doesn't have some sort of criteria or metric based around those sorts of things. So vital. I think, just to come back to your question, whether it's royalty, dividend, jurisdiction, I don't really think that matters. It just has to be a good story, a clear story, that investors can get on board with.
Yep. Excellent. Touched on a lot of things there. James, could I bring you in and just see if you share the same views there around the strength of the story, and how does it maybe work for some of the juniors that you look at or work with from a private equity perspective?
Well, I think perhaps if I can compare it to, just take a different perspective and compare it to TSXV and ASX, the prevalence of the explorers in those markets, they're getting valued. Those markets are valuing those companies based very much on the drill bit and contained ounces. And, that's not what is happening in AIM. I'd agree with everything that Sam had said. I think, AIM is much more around cash flow. AIM is much more around professionalism of the management team, about ESG credibility, about quality, robust, de-risked assets. I think, the AIM and LSE markets have had their challenges in the past with companies that perhaps have not performed to their expected fiduciary duties. So, there's very much a focus on fiduciary professionalism in AIM. I'm not saying that focus is not there in TSX and ASX, but certainly in TSXV and ASX, drill bit and contained ounces can be incredibly valued, and in some cases, you can find explorers on ASX and TSX that are valued at a premium to a producing company, which I don't expect to see on AIM anytime soon.
Yeah, so a cultural difference there, sort of triggering that premium.
Yeah, and I'm not saying one is better than the other. I'm just comparing the two and saying they're different. The different risk profiles, different investor appetites, and I think people and companies that come to AIM and London Stock Exchange should be cognizant of that, and bringing the stories that are appropriate to the AIM marketplace. Don't think that the AIM marketplace is by any means similar to ASX or TSXV.
Yeah. Peter, could I jump back to you? Something that Sam mentioned around sort of strong capital discipline being something that is obviously fundamental, but something that investors have looked for certainly a lot more since the last cycle. This is one of the strengths that you can deliver as a company. Can you share some light on what the investor focus is towards that
Sure.
right now? Is that still a top priority from your shareholders, for instance, who are looking at this favorable price environment and saying, are they saying, maintain it, improve cash flows, etc.?
Sure. Yeah. But I think in order to answer the question, what I'd like to do, Adam, is perhaps if I can provide to take a step back for a moment and afford myself the luxury of history. When I took this company public 17 years ago, a mere 17 years ago, we were an advanced exploration type company. We had one very small producing asset that we'd acquired from Vale. But really the bread and butter of the company and the future of the company was some advanced exploration assets that we were taking through feasibility study and then ultimately developing, and we did develop. And while I'm not suggesting that every company that is on the cycle on that continuum would do the same thing or follow the same path, we meet with a lot of London investors, European investors, a lot of generalist investors. And if I can provide further context, I would say that in many respects, almost all of us, not everyone, but almost all of us, including in many resource funds, are generalists in some respects. We certainly don't have, I'm a business person. I'm not a geologist. I'm not an engineer. I hope I can say that I can take advantage of opportunities as we have in this company. And I can see where there is a wisdom coming from the competency of geologists and engineers. And in that context, it seems to me that we're all somewhat generalists. And so there are high quality generalists that can still understand what is the value proposition. And at the end of the day, it's the value proposition, rather than complicating it by talking about the specific structural geology and what a particular drill intersection means. What does the big picture mean? We had an asset in 2003 through to 2006 that we were to bring into production. It was a low-grade gold copper asset. And again, if I can share a little bit of that history, the first reaction to it would have been, it is one of the lower grade deposits in the world. On the other hand, it had a strip ratio of less than 1:1. So the waste to ore ratio was very, very low. And that meant that the strip adjusted grade was significantly higher than it first appeared. So explaining it to people in sort of that business fashion made it make more sense. When we ultimately brought it into production, those generalist investors could look back on it and say, well, I'm glad I invested and it was made simple and you've achieved the objectives that you sought to achieve. So I think that context is important. I don't think we should just dismiss the fact that because it's generalist, it will be more difficult for non-producing, non-cash flow generating companies to attract the attention of those quote unquote generalist investors in London, Europe, and elsewhere. But if we look at it from the lens of what is most important today, certainly for our company today, I'd say that the comment that was made about ESG, a record of sufficient ESG management, perhaps high quality or higher quality ESG management. I think investors want to look at how diversified is a portfolio. And that diversity is something that Randy mentioned. I wholeheartedly agree. What is the mine life of the assets? And does the company have a track record of replenishing what it mines that shows longevity? On balance, does it deliver consistent results? I think that that's important as well. If a management indicates that it's going to do something, has it done it? We all have our challenges, but on balance, have we delivered on what we said that we would do? I think this is an important thing for London investors to understand. Does a company operate in jurisdictions that are rules-based, preferably with a tolerance for and a pedigree in mining? We prefer to be in mining-friendly jurisdictions in the Americas. That's our business model. I'm not suggesting by any means that there aren't other places that are not in the Americas that are not mining-friendly. But essentially, we're looking at mitigation of risk. This is about mitigation of risk. And so jurisdiction plays part of that. And so is it rules-based? And if it's rules-based, and preferably if it has a tolerance for and pedigree for mining, that makes it easier for investors to become attracted to the investment. Does the company demonstrate financial resilience? And financial resilience is more, in my view, than just cash flows. Even a non-producing company will have to manage its balance sheet effectively. And if it's demonstrating that it can do that, then I think it makes for a worthy investment to look at. is the company committed to a balanced capital allocation strategy? We look at it and say, we've got three priorities. We want to manage our growth with internal resources, manage our balance sheet. It's in excellent shape, but to keep it in great shape and even perhaps better shape. And of course, return cash to shareholders by way of a dividend. And that part is important. Does the company have a strategy that allows it to introduce, if it is not yet paying a dividend, and then ultimately to pay and to increase those cash returns to investors, and the ability, as I mentioned, to increase those returns? If a company can demonstrate that financial thesis, then I think it is worthwhile for anyone, including generalists, to take a look at. And even generalists who don't understand mining will understand the value proposition.
Absolutely, excellent. Touched on a lot of key things there. Randy, just to finish on the point around generalist capital then, do you have a view or do you feel slightly in a different position being on the streaming and royalties side of things, that when you talk to generalists, you can have a slightly different conversation there?
Oh, no doubt. In effect, my business is supplying capital to the industry. And so it's something that we monitor and watch. And I have fond memories of the 2013 to 2015 period that Sam mentioned, because there's two times that we supply capital to the mining industry. One is, of course, to help fund development projects and help fund growth. But the other one is to help strengthen balance sheets. And those stressed balance sheets that all the big diversifieds had from 2013 to 15 allowed us to get access into some world-class assets and get streams on these assets. And the money that we supplied in purchasing those streams went directly towards strengthening those balance sheets. So, those were opportune times for us to come in and help correct some of that capital undiscipline. But on the other side, on the development side, our business model, again, in terms of funding growth and funding development, the one huge attraction that a stream has on any development project is how dramatically it improves the return on invested capital. And I'm going to use a specific example as our core asset, our core franchise asset, which is the Salobo mine down in Brazil, owned and operated by Vale, where last year we received 278,000 gold ounces from that mine as 75% of the gold stream. It's a copper mine that has a very, very impressive, it's a very profitable mine as a whole, but it has a very impressive gold byproduct stream. That mine cost about $4 billion to build. Our stream, we supplied about 3.1 billion of the capital for that mine, which means that we supplied close to 80% of the capital, and yet our revenue is about 17%. We take away about 17% of the revenue in our stream. The Vale shareholders, their net investment into that mine was about $800 million, a little bit over $800 million. You can imagine the return on that invested capital. That's why streaming has had such great success since we created the model 16 years ago, is that, on the development side, if you've got a good mine and you want to make it a great mine, a stream will dramatically improve the return on the invested capital for the operator shareholders, which is what has been, especially after the experiences that we've had 2010 through to about 2014, 15 with so many over-levered companies that put a lot in, invested at the high part of the cycle, and had to bear that heavy debt burden for a long time. This is an excellent way to finance and to strengthen, and I like to say it's a way to take a good mine and make it a great mine.
Yep, certainly, absolutely. Okay, great. Eric, could I bring you back in here? There was a lot of talk there sort of around de-risking and growth strategies, but actually I wanted to get your view, as earlier stage projects, surely in this environment, there's a lot of value to be created here at the junior end of the gold mining spectrum. Could you talk us through some of your views on that?
No, there certainly is, and it's interesting because the capital we just raised last month was exclusively for
Oh,
that
sorry,
we acquired.
Lost you a second there. Just cut out.
Sorry.
Can you just repeat that?
Right. Okay. So the capital that we raised last month was earmarked for exclusively a non-producing asset, an exploration property. So it goes to show that there is capital in London from the generalist pool for non-producing assets, but it's underpinned by a producing asset in our portfolio. Now, what I'd say is the story that we presented was very simple. You know, it's moving a project from where it is today at an inferred resource through to a feasibility with infill drilling. And we broke it down into very simple phases that the generalist could understand, and those that know mining could validate as well. So exploration certainly is exciting, and this is where you're going. We could pitch the exponential return, and then underpinned by cash flow. Now, I think there's been a lot of good points about what's important to bring to the investor community. I think two additional points. One is alignment of management teams. So effectively, there's countless examples of agents and not principals. And this typically, if you look at the history, it typically ends up in these distress situations. But I think alignment is really important. And in London in particular, some of the feedback we got consistently from the investment community was around dividends. And it's hard to grow while you're paying dividends. But as an example, in London, I think the stat is that 50% of UK PLC has had or 50% of all dividends from UK PLC have been cut. And so that presents, there's a gap there, for other businesses like precious metals to fill.
Yeah, certainly that capital rotating out from other underloved asset classes, if you like, or underperforming, asset classes to come into mining as it starts to look at paying dividends. Excellent. Okay, I'm just conscious of the time, but want to raise on a few points that were covered in the various responses there. Firstly, talking about a growth strategy, and M&A activity. I wonder if perhaps, Sam, we could start with you. Do you see this as a time that M&A activity is going to be picking up? And is that going to be a good thing for the market? Or do you think that people are still very, very cautious about acquisitions, given the last cycles, what had happened then?
Yeah, look, absolutely. I mean, with gold at circa $2,000, everyone's got plenty of cash. Anyone operating, at least, has got plenty of cash. And I alluded to capital allocation before, and M&A is just one of those. I expect, given that, we will see an increase in activity. And really, it again just comes back to the quality of the deal, the rationale of the deal. Where are the synergies? What's the strategic advantages? And investors will judge each one on their merits. So, I'm hesitant to say that blanket investors will like M&A or not like M&A. It's very much on a case-by-case basis, and assessing where the value is. Again, I reference again that period a few years ago that a few of us have mentioned, where capital wasn't well allocated. So I think that really it again comes back to how that capital is used and what the value case is that can be communicated to the market. And if there is value there, then I think investors will be there to fund it.
Yep. Okay. Peter, you mentioned your growth strategy in one of your responses, and I just wanted to hone in on that a little bit around the topic of M&A. With an improved sort of cash flow environment, do you think, is there pressure now from shareholders to say go out and acquire new assets, or is the path to replacing mine ounces very much still an organic strategy?
Yeah, really good question, and I have to confess, Adam, that I'm of two minds. I'm not convinced that we are in an M&A market at this juncture.
Sure.
If we look at the history of our company, we've engaged in consolidations, business purchases, We completed two significant ones in 2006, a very significant one in 2007. And we own the Canadian Malartic mine, which is Canada's largest mine, in partnership, because of a corporate transaction in 2014, where one of our peers, Goldcorp, was engaged in a hostile takeover bid of a company, Cisco, and we came in as the quote-unquote white knight in the protection of that company, and we ultimately wound up acquiring it. So I've certainly been a big proponent of consolidation. I think that this is a fragmented industry, but I'm not convinced that we're at the point where there will be large-scale consolidations. It seems to me that there are different buckets of what's happening with some of the transactions, and it doesn't yet form a picture. Perhaps if I can mix metaphors a bit, it looks as if we've got pieces of a mosaic, but we don't see yet what the entire picture looks like, and we may not for a while. I think it's critical for a company to say, this is our growth strategy, and this is how we look at growth. There are several buckets of opportunity, I guess. But what I can see from the transactions to date is that in some cases it was perhaps the classic corporate equivalent of one company scratching the itch of the other, and vice versa. In some cases, I can see that there is some opportunity for synergy, but that's very rare in our industry. And in some cases, I can see the merits of a transaction based on creating a critical mass. Unlike other times in the cycles, certainly for precious metals companies, it seems to me that size matters more today than it has in the past. So clearly, quality still matters the most, but size matters more than it has in the past. Creating that critical mass in terms of number of ounces of production, number of mines that are in production or in development, number of opportunities, in other words, but also the market capitalization of a company. So to recap, I think companies should identify what is their growth strategy. That I think will make it easier for investors to understand if they engage in a corporate transaction, why they engaged in it. I think it's important for investors to hear from companies that we are going to deliver returns on investment when we make acquisitions. That will not always be true immediately, but it has to be true over time, that we can deliver value added to a transaction, that we can improve the quality of assets that are being acquired, that there is a reason for the transaction other than just creating a business combination. Bigger is better today than it has been in the past, but there still has to be the quality side of it. And I think that quality side is critical. So I don't know that the picture is complete for me to say that we're in an M&A market at this juncture. It seems to me that we might be a ways off from that. But the transactions that have occurred to date have been very particular. As I said, one company scratching the itch of the other, and vice versa, or there have been synergies, and it's easy to recognize those synergies, or there is enough of a critical mass created that it does become, from a size point of view at least, a 1 + 1 = 3 or = 4 scenario. But those are rare transactions, and there still have to be other factors that have to be considered before one engages in business combinations. Where I see the opportunity, particularly for companies our size, is more for some of the advancing situations, like our purchase that we announced earlier this week, where it is not yet in production, perhaps not yet at development stage, but where we can provide value added and we can buy it at a price that we can deliver an acquisition IRR that is still well above and perhaps even a multiple of our cost of capital.
Absolutely. Excellent coverage there. James, could I get your view on M&A from someone that looks at a lot of companies, a lot of junior companies as well? Would you agree with some of those sentiments there about it being very not yet in a full flow M&A environment?
Yeah, sure, Adam. And I tend to agree with the sentiments of Peter, in that I think you can look at M&A in the junior space, and you can look at M&A from the major companies' point of view. And I think perhaps there are some strategic M&A rationalization opportunities, such as recently happened on the ASX associated with Super Pit. But they're few and far between. Generally, at the moment, I think for the major companies, it's quite hard to see value in the marketplace. And I think Mark Bristow came out a few weeks ago and said something to that effect as well. Particularly on the ASX and the TSXV, those development stage, exploration stage projects that are clearly of quality, there's been a flight of investors to those companies, and those assets are now incredibly valued, and hard to see how companies can generate attractive IRRs, as Peter just mentioned, from those sort of investments. So yeah, I don't really see M&A being a significant uptick in the next few months, not with the current environment. It is hard to find good quality assets in the marketplace, as I said.
Yep, absolutely. Eric, could I bring you in here to talk about not necessarily M&A, but more about growth strategies, and what's the view from the junior company? What is your growth strategy from here? You've had some exciting news flow come in recently. And also, how do you turn these quality assets into real development, developed into proper mines?
Yeah, no, we'll cover that in a minute. I mean, there's probably just one or two points that I think worth adding on the M&A topic, and then I'll get into the growth if that's all right. But I think what's often misunderstood is that M&A is often social issues underpinning M&A that make it much harder than people think. So it's one thing to find an attractive asset, it's another thing to actually affect a corporate transaction. And then I think when you look at M&A, there's really two buckets. You have corporate and asset, and where you have an asset transaction, the social issues aren't typically around, because it's a sale from a non-core position in a portfolio. And so what we see, corporate M&A, I think it's hard because as the gold price goes up, you have agents or underperforming management teams protected by a buoyant gold price environment. Where you might see M&A is on the asset sales or on typically non-core disposals. And that goes on to the point about growth, because as you do see those non-core disposals proliferating across the industry, that is a source of, I guess, inorganic growth for the junior and the mid tiers to grow through scale, and to do that through acquiring non-core assets out of the majors. And just because a major is selling an asset doesn't mean it's a bad asset. There's countless examples of assets that have been company makers for the mid tiers. And so when we look at our own growth portfolio, our own growth story, it really comes down to we have 3 assets now in our portfolio. There's a lot of value to demonstrate, and we want to make sure that we allocate that capital appropriately to be able to demonstrate why we think the share price or the market cap should be a lot higher than where it is today. What that actually means is our own growth story with our producing asset is to replace ounces and to harvest cash. Our growth story with our non-producing assets is to demonstrate the value that we think is inherent in those properties. In terms of growth through M&A, it's opportunistic at best. I think there has to be a particular angle for a management team to consider M&A, and if there isn't, typically you could scratch your head and wonder why there is an M&A transaction.
Yep, absolutely, great. Okay, that's great. I'm very conscious we've just got 5 minutes left, aside from the technical disruptions. Peter mentioned ESG earlier, and I just want to sort of focus in on that, because it's something that all of these panels that I do with investors, it's always a huge part of the discussion now as the ESG criteria evolves, whether it's the generalists or the mining specific funds that we're talking to. So I just wanted to put to the panel, within the next 12 months, what would you see as the sort of area that you would want to put, that mining could talk up its game a little bit more on the ESG front? Or is there a particular pillar within the ESG reporting standards or deliverables? Not to say that mining's not doing it, but needs to project its story a little bit better around that. And let's just go around the panel. Actually, Peter, perhaps we could start with you because you raised it in your previous comments.
Well, I think the appreciated part of ESG is the G part. I think that we need to be very much focused on governance. Every company will do its best to make sure that it's managing environment effectively, making sure that they're taking care of the health and safety of its workers and its local communities, and managing local communities and social issues more generally. I think the governance part is really the driver and the one that needs to be emphasized, and the one that I think investors should appreciate, because the governance will drive the rest. The governance will determine in many respects not only the model for how we take care of environment, social, community, health and safety, but also the issue of how we create the culture within the enterprise and its specific operations, the culture of protecting these things, promoting these things. So I think governance is critical. The transparency that goes into that, an excellent example today, an important part to ESG is what does one do with tailings? And one of the things that we did years ago that I think is critical and does go to governance is that the person who is responsible for tailings does not have a reporting line through operations. And while he has a reporting line to a senior vice president who is responsible for health, safety, environment, and community matters, he also has a direct line of communication directly to me as executive chairman of the company and to our sustainability committee, and therefore our board of directors. And I think that that's critical. I think that that's clearly just an example, but it's an important example of how governance drives relationships, drives culture. We're trying to create a culture that protects environment, protects communities, is responsibly taking care of health and safety issues, et cetera. And I think to be able to get that, one has to ensure that you're focusing on the governance model and communicating that effectively to investors.
Certainly, thanks. Randy, could I come to you for your take on ESG, and perhaps is there a pillar within that you might be focusing on within your portfolio companies for the next 12 months, say?
Well, one of the things that I think needs to be hammered home is that this mining industry, we have a very unique ability to deliver a much higher standard of living in remote locations, in rural locations, and so much of the rest of the world is focused on bringing people towards population centers and sort of just losing it. And so the benefits that we deliver in rural locations in terms of improved standard of living and all the way across the board, the industry has always delivered that. I just think we have to really sort of resonate the importance of that and just sort of drive that home. Really, I do think that successful businesses have always had strong ESG practices. And I think the biggest change that we've seen over the last few years is the disclosure of it, is putting that in place. But I bin it all under a broad term called social license, which captures the regulators, it captures the communities, it captures all the stakeholders. You don't operate successfully without strong social license. We're a streaming company, we don't operate. And I mean, for years, royalty companies have had a free ride on this, but we kicked off strong ESG commitments and we put funding into the communities around the mines where we get our metal from, even though we don't operate these things. And the reason we do that is because it strengthens our partners' social license. And that's really what it comes down to is the importance of driving that home, of strengthening our own, strengthen the sustainable benefits that we are leaving with our neighbors in these communities. And so what I see over the next 12 months is just continuing to drive that home. I think that the area we should focus on, and I would look back at the last 12 months. It's always a good way of projecting where we're going. And the World Gold Council itself has come out with responsible gold mining principles that really have set a standard of expectation in terms of a minimum that we will, as a mining industry, deliver to all of our stakeholders. And it is one of the aspects. This is talking a little bit London centric. As a North American company, Europe is ahead of the game on this, and we see a lot more interest, a lot more knowledge about ESG issues and matters in Europe and in London we've traditionally seen over North America. And you know, I think you are ahead of the game in Europe on this front. And you know, over the next 12 months, hopefully North America continues to catch up on that front.
Excellent, absolutely. Eric, just coming to you for the East African perspective for projects over in East Africa around ESG. Do you think that it's very much the social license to operate is based around the qualities of your communicational strategy or your skills within community building? Do you think those are the key focuses at the moment?
Yeah, 100%. In East Africa, anyway, the social license to operate is everything. And I mean, if the communities don't want you there, you know, you can't rely on the rule of law. You have to have the communities on board with what you're doing. Now, one thing that we've done quite differently, and we took a lot of, we had a lot of people question this three and a half years ago. We've indigenized the workforce as much as we could. So we're now 99.5% Tanzanian across the workforce. Both GMs. I think there's all but one head of department. There's literally 5 people that aren't Tanzanian, and those people are operators. They're not senior decision makers, and that's gone incredibly well with the host government. It increases the level of trust because the host government sees the indigenization as their first point of contact at the operation. So social license to operate for us is paramount. It's right at the top. Now, I just want to mention, particularly, from my perspective, I think, mining is notoriously a pretty dusty, or extractives are a pretty dusty and dirty business, in terms of, there's just a lot of big equipment, there's a lot of things going on. The sooner the mining industry can embrace climate change, the better. And there are a lot of enablers to do that. Autonomous, electrified, solar. There's a lot of good things where we don't have to rely on fossil fuels, and I think the sooner that happens, the better.
Yep, certainly. There's a big, within line with the big decarbonisation trend. Sam, could I come to you for your take on some of the companies that you look at with regards to ESG? Is there an area that you think that they need to be focusing a little bit more on? Is it this decarbonisation notion, or maybe it is very much around the governance and that strong community building ethic? What's your view?
Well, look, I think, while my personal view is that ESG in general, all 3 components of that should be viewed as a qualitative overlay when an investor is looking at a stock, much like management quality overlay. There is a huge sub-industry here of companies and efforts to basically try and quantify ESG as to how that plays into value and the investment process and the investment framework. So that being the case, I think companies, while it's never going to be perfect, should try and explore what metrics they can disclose in order to make sure they're ticking those boxes. So it's not just the carbon things like carbon footprinting and so forth. It's about social. We talked about Eric just talked about indigenization of the workforce. Those statistics. Do you have an anti-bribery, anti-corruption policy on the G side? These sorts of things are the types of binary tick box metrics that some of the ESG screens are now looking for. And it's important for companies that want to get past those to make sure they've got the right numbers, they get screened correctly, and then that gives them a chance to tell their story more directly to the investors in a quantitative fashion.
Absolutely, excellent. Very rounded point there. James, could I just come to you to sort of wrap us up? And I'm conscious we're sort of run out of time now, but this is very much the London discussion based around sort of opportunity here. Unless you had anything sort of you really wanted to add on ESG, could you just talk us through maybe some of the exciting potential IPOs that might be coming out in London in the next sort of 3-4 months, or as we go into next year? Was there anything particularly on your radar there that could give us a final view on the opportunity for London?
Well, thanks, Adam. I can actually talk to both. And if you give me an opportunity, I'll just put a plug in for one company that will be IPOing on AIM in the next couple of months, early in the new year, and that is a company by the name of Senko for Gold. It's a project that we've been funding the development of through to construction for the last 3 years. I think about 80 million spent to date, but it's an open pit gold project in Ghana. The IPO is to raise money to construct the mine. CapEx of 167 million, NPV post-tax, post everything of 364 million at 1,650 gold price. IRRs of nearly 40%, 2-year payback period, producing 100,000 ounces of gold. It's a great project for investors to look at in the gold space from our point of view, producing 2 grams a ton, more than 100,000 ounces per annum. But the main thing that I actually want to talk about with that project is its ESG credentials. And I think the key takeaway here is that investors that ignore mining investment opportunities because of ESG are really ignoring the detail. And if we look at this project in particular, this company, I mean, that company has spent $60 million to date in regional Ghana. This year alone, it employed 622 local Ghanaians from the local community, and more than 1,000 to employ during construction. It uses 50% renewable power. It will be the major employer and wealth creating hub for Northwest Ghana, supplying new freshwater supply, new power supply, new telecommunications to that region. The benefit, the S of ESG, the benefit of that project to Northwest Ghana is significant. And, for that reason, I think investors should certainly be looking at mining and the attitudes that it has now towards ESG. And I think mining does represent attractive ESG investment opportunities for the AIM marketplace.
Absolutely. Excellent. Well, look, we're right out of time, but I'd like to thank everyone there. We've covered some fantastic points around the opportunities in AIM LSE, the London marketplace, keeping the story simple, having clear phases, maintaining strong fundamentals, good governance, transparency throughout the operation and the company management as well, cost discipline, and many more key points to observe there if you're an investor looking to get exposure to good gold mining equities. But I'd like to say thanks very much to my panelists, to Peter, Randy, Eric, James and Sam, and that's hopefully been a very good insight for our viewers as to where to look for exposure to gold companies in the London market.
Pleasure, Adam.
Thanks.